Welcome to Investor Web, where we break down complex investment topics into simple, understandable concepts. Today, we're diving deep into the fascinating world of real estate economics. This topic is a cornerstone for anyone who has a keen interest in the investment sector. You see, real estate is more than just bricks and mortar. It's a dynamic field that intertwines with various economic factors. Whether you're a seasoned investor or just starting your journey, understanding the economics of real estate can be a game changer. It can provide you with the tools and insights to make informed decisions, navigate market fluctuations, and ultimately maximize your return on investment. In this video, we'll unravel the intricacies of real estate economics, exploring everything from the basic principles to the impact of government policies. So get ready for an enlightening journey into the economics of real estate. Stay tuned to uncover the mysteries of real estate economics. Real estate economics is not as intricate as it may seem. It's a vast field, yes, but its core principles are fairly straightforward. And these are the building blocks we'll be focusing on today. At the heart of real estate economics, as with any market, lies the concept of supply and demand. This principle is simple. When the demand for properties is high and the supply is low, prices tend to rise. Conversely, when there is an oversupply of properties and demand is low, prices usually fall. This ebb and flow of demand and supply is pivotal in determining the value of real estate. Next, let's talk about location. This is a key factor in real estate economics, often encapsulated in the phrase location, location, location. The desirability of a location can significantly influence property prices. Factors such as proximity to amenities, quality of local schools, employment opportunities, and even the scenic view all play a role in determining a property's value. A penthouse in central London, for instance, will have a different valuation than a similar-sized property in a rural area. We also can't ignore the influence of government policies on real estate economics. Policies related to taxes, interest rates, zoning laws, and housing regulations can drastically affect the real estate market. For example, a decrease in interest rates might make mortgages more affordable, thereby increasing demand for properties. Similarly, tax incentives for first-time home buyers could also boost demand. Lastly, we must mention the role of economic conditions. The overall health of the economy, including factors such as income levels, unemployment rates, and consumer confidence, can impact the real estate market. In times of economic prosperity, people are more likely to invest in real estate, driving up prices. However, during an economic downturn, the opposite can occur. With these basic principles, we can start to unravel the complexities of real estate economics. Understanding these fundamentals can provide a solid foundation for anyone looking to delve deeper into this fascinating field. Remember, real estate isn't simply about bricks and mortar. It's about people, policies, and places. Numerous factors come into play in real estate economics. First, let's talk about population growth. This is a crucial factor that directly affects the demand for property. When a region's population is on the rise, the demand for both residential and commercial real estate tends to go up. This increasing demand can drive up property prices and rents, leading to greater potential returns for real estate investors. Next, let's consider income levels. The average income of a region's residents can significantly influence the real estate market. If people are earning more, they're typically able to afford higher-priced homes or rent more expensive offices. This can push up property values and make real estate a more lucrative investment. Interest rates also play a big role in real estate economics. When interest rates are low, borrowing money to buy property becomes more affordable. This can lead to an increase in demand for real estate and consequently a rise in property prices. On the other hand, when interest rates are high, buying property becomes more expensive, which can reduce demand and cause property prices to fall. Finally, we need to consider the overall economic conditions. In times of economic prosperity, people generally have more disposable income and are more willing to invest in real estate. Conversely, in times of economic downturn, people might hold off on buying property, leading to a decrease in demand and potentially lower property prices. These factors are all interrelated and can influence each other in complex ways. For instance, a booming economy can lead to higher income levels, which can increase demand for real estate, thereby driving up property prices. It's also worth noting that these factors can vary greatly from one region to another. What applies to the real estate market in one city or country might not necessarily apply to another. This is why it's so important to understand the specific market conditions of the area where you're planning to invest. Understanding these factors can help you make informed decisions when investing in real estate. Economic conditions can greatly impact the real estate market. This statement is as true as the law of gravity. When the economy is booming, people have more money to spend, businesses are expanding, and optimism is in the air. This generally leads to increased demand for real estate, pushing prices up. Conversely, during economic downturns or recessions, the real estate market often takes a hit. People may lose their jobs or face reduced income, making it hard for them to afford a new house or maintain their current home. Businesses might halt expansion or even downsize, reducing the demand for commercial properties. This can lead to an increase in supply and a decrease in demand, causing real estate prices to drop. But it's not just the overall state of the economy that matters. Specific economic indicators can also have a significant impact on the real estate market. For instance, when interest rates are low, borrowing becomes cheaper. This can encourage people to take out mortgages and invest in property, driving up demand and prices. On the other hand, high inflation can erode people's purchasing power, making real estate seem less affordable and potentially causing a slowdown in the market. It's also important to consider the job market. Areas with high employment rates and good job prospects often see strong demand for real estate as people want to live where they work, but in areas where jobs are scarce, demand for property may be low. And let's not forget about consumer confidence. If people are optimistic about their financial future, they're more likely to make big purchases like homes. But if they're worried about the economy, they might decide to hold off on buying property. In short, the economy and the real estate market are deeply intertwined. Changes in economic conditions can create investment opportunities for those who are prepared. For example, a recession might be a good time to buy property at a lower price, with the expectation that prices will rise again when the economy recovers. Being aware of economic conditions can give you an edge in the real estate market. So, keep your finger on the pulse of the economy, and you'll be better positioned to make smart real estate decisions. Government policies can significantly shape the landscape of real estate economics. Let's take a closer look at how this happens. Picture a chessboard. Each piece on this board represents a different type of policy, and each move can change the game's outcome. In the world of real estate economics, the government is the player, and the policies are the chess pieces. One of the most influential pieces on our chessboard is zoning laws. These regulations determine what types of buildings can be constructed in specific areas. For example, a law might specify an area for residential use only, prohibiting the construction of commercial properties. This can impact property values, demand, and the overall landscape of a neighborhood. Another critical policy piece is tax credits. Governments often use these as incentives to encourage certain types of real estate development or investment. For example, a government might offer tax credits for developing affordable housing or for rehabilitating historic properties. These incentives can shift investor interest towards these types of projects, influencing where capital flows in the real estate market. Now let's consider a third piece on our board, interest rate policies. These are set by central banks and can greatly influence the cost of borrowing. When interest rates are low, it becomes less expensive to borrow money, which can stimulate investment in real estate. Conversely, when interest rates are high, borrowing becomes more expensive, potentially cooling off the real estate market. Each of these policy pieces, along with many others, plays a crucial role in shaping the real estate market. They can influence everything from property values and investment trends to the rate of new construction and the availability of affordable housing. So, as an investor, it's important to keep a close eye on these policies. Understanding how they work and how they can shift the dynamics of the real estate market can give you a significant advantage. Keeping an eye on government policies can help you anticipate changes in the real estate market. Understanding the economics of real estate can significantly improve your investment decisions. We've journeyed through the fundamentals of real estate economics, highlighting its core principles. We've unpacked the intricate factors that influence it, from supply and demand to interest rates and inflation. We've also dived into the profound impact of economic conditions on real estate. Remember, when the economy is robust, real estate thrives, and when it's not, the industry faces challenges. We also looked at how government policies can sway real estate economics, emphasizing the role of tax laws, interest rates, and zoning regulations. It's crucial to keep an eye on these influences as they can make or break your investment. So there you have it, a comprehensive guide to understanding the economics of real estate. Keep these points in mind and you'll be well on your way to making more informed investment decisions. Thank you for joining us on InvestorWeb. Don't forget to subscribe for more insightful investment content.